Most Australians don't realise how much their superannuation can affect their age pension entitlements. Depending on how it's structured, your super could either increase your pension or reduce it significantly. In this video, I'll explain exactly how Centrelink assesses your super and share strategies that could help you maximise your payments in retirement. I'm Chris Toro, Managing Partner of Toro Wealth, where we specialise in retirement planning advice for Australians aged 50 to 70. I'm also the founder of superguy.com.au. If you're new here, hit that subscribe button so you don't miss a video. And this video is general information only and does not constitute financial advice, so please check out the full disclaimer in the description below. So how does Centrelink assess your super and why should you care? Well, superannuation is one of your biggest financial assets in retirement. The way that Centrelink treats it can directly impact how much age pension you're eligible for. Generally, the less that's assessed, the more you could receive. And even if you're not eligible for the age pension today, that can change over time as you draw down on your super. Planning ahead is the key, and the right strategies now can lead to higher payments down the track. Also, if you have a partner who has already reached age pension age, your super could still be counted in their assessment, unknowingly reducing their entitlements. That's why understanding how your super is assessed is so important. It helps you structure things in a way that maximises your entitlements. So let's take a look at how it works. When you're assessed, Centrelink looks at how much you own and earn to figure out if you can get the age pension and how much you'll be paid. Your superannuation is assessed by Centrelink under both the income test and assets test. I'll explain each one shortly. However, how it's treated depends on the type of account your super is held in. Let's start with super in the accumulation phase. This is the stage where you're still working and making contributions and your super remains in an accumulation account. Even after you stop working or retire, you can choose to keep it in an accumulation account where it stays invested and has the potential to keep growing. During this phase, if the account holder is under age pension age, 67 years old, Centrelink does not assess the super accumulation account. If the account holder is 67 or older, Centrelink includes the balance in both the income test and the assets test. Now, what if your super is moved into a transition to retirement phase? The transition to retirement phase applies when you're between ages 60 and 65 and start a transition to retirement, TTR, pension while still working. In this phase, a TTR pension is fully assessed for the income test and assets test regardless of your age. And finally, pension phase. Once you retire and convert your super to an account-based pension, your superannuation is assessed in both the income test and the assets test for the age pension. Now, if you have a defined benefit pension, it will only count towards the Centrelink income test, not the assets test. So how is the assets test different from the income test? Well, the assets test considers both financial assets like bank accounts and investments and non-financial assets such as home contents and vehicles. Super accounts, where applicable, are also included in your total assessable assets. If you're under age 67, the full balance of your accumulation account is not counted towards the assets test. However, for TTR pensions and account-based pensions, the entire balance is included in the assessment. What if you're over age 67? Well, if you're over age 67, the full balance of your accumulation account, TTR pension and account-based pension is treated as an assessable financial investment for the assets test. This balance is added together with all of your other assets. So how does it affect your age pension? This table outlines the asset thresholds for receiving the full age pension. For every $1,000 your total assets exceed the full age pension limit, your payment reduces by $3 per fortnight if you're single or $1.50 each per fortnight if you're a member of a couple. Okay, so now that we've covered how your super is treated under the assets test, let's take a look at how your super is treated under the income test. The income test is used by Centrelink to assess how much income you earn or are deemed to earn from all sources, including superannuation. For the income test, an accumulation account, if you're over age 67, TTR pension or account-based pension, is treated as a financial asset. But instead of looking at the actual income you receive, Centrelink uses something called deeming. What does this mean? Well, rather than assess the actual pension payments you withdraw or the real investment earnings in the account, Centrelink assumes or deems that your balance earns income based on fixed deeming rates set by the government. Current deeming rates at the time of this video for singles is 0.25% per annum on the first $62,600 and 2.25% per annum on the balance above that. For couples combined, it's 0.25% per annum on the first $103,800 and 2.25% per annum on anything above that. This deemed income is then added to any other assessable income you receive. So how does it affect your age pension? This table outlines the income thresholds for receiving the full age pension. For every $1 your assessable income exceeds the full age pension threshold, your payment reduces by 50 cents per fortnight if you're single, or 25 cents each per fortnight for each member of a couple. Again, defined benefit pensions are treated differently here. Instead of deeming, the actual income amount minus the deductible amount, as advised by your defined benefit provider, is assessed. Also, as a side note, investment properties are not deemed. The actual rent received minus the rental expenses is the amount assessed. So which test applies, the income test or the assets test? Well, Centerlink applies both tests to your financial situation and bases your age pension entitlement on the lower of the two results. In other words, whichever test results in a lower pension entitlement is the one that determines what you receive. For example, if you qualify for the full age pension under the income test but only half under the assets test because your assets are too high, then you'll only receive 50% of the age pension rate. So to bring this to life, let's look at a real world example. Graham, who's 68, and Catherine, 63, are a retired homeowner couple. Being 68, only Graham has reached age pension age. Their assets and their income is as follows. Home, $1 million. Home contents, $20,000. And this is the fire sale value if they had to sell their home contents today. Vehicles, $30,000. Also fire sale value. Graham's account-based pension has a $450,000 balance, paying him $2,500 per month. Catherine's account-based pension also with a $450,000 balance, paying her $2,500 per month. And they have bank accounts of $50,000 combined and shares of $10,000. Now, since Graham is the only one who has reached age pension age, he's the only one eligible for payments. Let's start by looking at what he may be entitled to, beginning with the income test, assessing each item individually. So starting with their home, this is completely exempt from age pension assessment, so will not be assessed under the income test. Their home contents and vehicles, while they are assessed, are not considered investment assets and are therefore not deemed to earn an income under the income test. What about income from Graham's account-based pension? As we discussed earlier, the actual income payments are ignored. Instead, the $450,000 balance is deemed, which I'll come back to in a minute. Just like Graham's, Catherine's account-based pension is also assessed based on its balance, not the income it pays. And although she's under age pension age and not personally eligible for payments, her $450,000 balance is still counted and deemed when calculating Graham's entitlements. There is a potential strategy here that I'll cover later in the video. Graham and Catherine also have bank savings of $50,000 and shares of $10,000, which will also be assessed and deemed. Now, even though Graham is the only one eligible for age pension payments, all assets are combined and assessed as a couple. They are not halved. So we've determined that the home, the contents and the vehicles are not assessed for income test purposes. The value of the account-based pension, bank balances and shares are classified as financial investments. Therefore, their values are first added together and deemed. So $450,000 plus $450,000 plus $50,000 plus $10,000 equals $960,000. We then calculate the deeming rates for a couple. On the first $103,800 at 0.25%, that equals $259.50. The remaining $856,200 at 2.25% equals $19,264.50. Total deemed income equals $19,424 per year, and that's $750.92 per fortnight. Now we can apply the income test for a couple. So in this case, the deemed income was $750.92 per fortnight. We minus the income threshold limit of $372, and that gives us $378.92 over the threshold. The age pension payment is reduced by 25 cents for every $1 over the threshold. So we times $378.92 by 25 cents and we get $94.73. Now we minus the $94.73 from the full age pension rate of $866.10. And we get Graham's final entitlement under the income test of $771.37 per fortnight. But we can't stop at the income test, because remember, both tests are applied, and the one that results in the lowest age pension is the one that's used. So now let's look at Graham's entitlement under the assets test. So under the assets test, we have a home that is not assessed. We have home contents and vehicles that are assessed, and we have superannuation pensions, bank accounts and shares that are also assessed. Adding them all up, we have assessable assets totaling $1,010,000. Now, we can apply the assets test for a homeowner couple. So we take the $1,010,000 in assessable assets and minus the asset limit of $470,000, giving us $540,000 over the threshold. The age pension reduces by $1.50 per person per $1,000 over the threshold. So we divide $540,000 by $1,000 and that gives us $540. We times $540 by $1.50 and that gives us an $810 reduction. We minus that from the max age pension of $866.10 and we get a final entitlement of $56.10 per fortnight under the assets test. So to recap, under the income test, Graham was eligible for $771.37 per fortnight, and under the assets test, he's only eligible for $56.10 per fortnight. Since the asset test gives the lower payment, this is the one that applies. Now, $56 would barely buy 2 chicken palmies, even on a Wednesday special at the Bowls Club. So what strategies could we use to boost Graham's age pension entitlements? Well, there are a few, and since Graham is affected by the assets test, that's where we'll focus our attention. A simple but effective strategy is to transfer Catherine's super pension back into accumulation phase. Since she is under age pension age, her accumulation account is completely exempt from Centrelink assessment. This move reduces their assessable assets from $1,010,000 down to $560,000 and increases Graham's age pension entitlements from $56.10 to $731.10 per fortnight. That's an improvement of $17,550 per year. But let's not rest on our laurels just yet. We want Graham to get the full age pension. To do this, we could withdraw $90,000 from his account-based pension and contribute it to Catherine's accumulation account, where it's effectively exempt. This reduces their total assessable assets to $470,000 and deemed income below $372 per fortnight, making Graham eligible for the full age pension. One thing you should be mindful of is that moving money from an account-based pension back to an accumulation account means those funds are no longer in a tax-free environment, and earnings in the accumulation phase are taxed at 15%. So you should weigh up any additional tax payable against the increase in age pension payments. In most cases we've seen, the increase in age pension outweighs the tax cost. Also, there may be accessibility issues by withdrawing and contributing to a younger spouse's account, so make sure that you won't need those funds until the younger spouse has access to their super. Now, I am fully aware that the above can only be achieved if one partner is under age pension age and if we're talking about a couple. But what if both partners are over age pension age, or if you're single? Well, here's a few options. Gifting assets. You can gift assets to a loved one, such as a child, to reduce your assessable assets and income, but there are rules. Up to $10,000 per financial year and a maximum of $30,000 over 5 years can be gifted without ongoing assessment by Centerlink. Gifting more than that? Well, the excess is still counted for 5 years as if you still own it. Importantly, once a gift is given, it's legally the other person's property. They're not obligated to return it to you. Also, a loan is not a gift. Any loans made to family or friends continue to be assessed as your financial asset, regardless of how much time passes. Another option to boost the age pension is to complete home improvements or pay down your mortgage. Given that your home is exempt from age pension assessment, any improvements made to your home will not increase your assessable assets. Also, paying down home mortgage debt and effectively increasing your home equity will not increase assessable assets. Just remember, by doing so, you are reducing the funds that you have available to achieve your retirement income needs. Another strategy you might consider is prepaying for a funeral or purchasing a funeral bond. Up to $15,500 per person can be exempt from assessment using this strategy. Some of these strategies may seem simple, but you would be surprised how easy one little change like this can make a significant difference to your retirement outcome. Our clients benefit from this every single day, and there are literally dozens of strategies just like this, not only in relation to the age pension, but in regards to superannuation and retirement planning in general. So if you're someone who wants to optimize their financial position in the lead up to retirement, this is where we can help. At Toro Wealth, we specialize solely in retirement planning advice. We aim to give you confidence about when you can retire, the retirement income that you can achieve, and how to optimize your financial position in the lead up to retirement. If you're interested in learning more about our service and cost, head over to torowealth.com.au. And if you got value from this video, remember to click the thumbs up button below and subscribe to this channel.